Hi, my name is Lilia Kirilenko. I'm one of the best ACCA tutors, and I'm going to show you how cryptocurrencies can be tested. My job as a tutor not to just give you SBR or financial reporting knowledge, not just to give you IFRS requirements. My job is to make sure that you understand what the standards mean. My job is to make sure that you will not get afraid when you see a strange word in the scenario, regardless whether it is related to sustainability reporting, cryptocurrencies, gold accounting, or anything else. So we can actually take cryptocurrencies to practice different standards. And that is what can happen with you in your exam. Let's have a look at this question and see how we'll look for the answers in the scenario itself. On 1st of January 2023, Clocks bought 100 million worth of ARM, a new cryptocurrency. It originally recognized it as a financial asset carried at fair value through profit and loss. As a result, on 31st of December 2023, it revalued it to its fair value of 105 million. On 31st of December 2024, the fair value of the cryptocurrency dropped to 97 million, and it recorded a loss of 8 million in profit and loss statement. Clocks has anticipated this, so on 30th of November 2024, it started looking for a buyer for the cryptocurrency when the fair value was 98 million. However, because the buyer fell sick with COVID, the deal was postponed until January 15th, when Clocks was paid 93 million. All cryptocurrency transactions are subject to a broker's fee of 1%. Have you noticed 5 standards being tested here? Let's see. So when we approach a question, it's not about yes or no. No. Instead, it is about the process of answering the question. So basically what we need to do, we need to look at each and every sentence in isolation and say what it means. Let's have a look. So the company bought 100 million worth of ARM, a new cryptocurrency. So we will need to say when to recognize it, and it will be this date, and in what amount. Now, in order to do that, we need to know what line the cryptocurrency should be written to. And we were told that it originally recognized it as a financial asset. Now, be very attentive. If you were told that it originally correctly recognized it, then this means that the examiner thinks that this is the right approach and you should not challenge that. You will not get any marks for challenging something or explaining something that has the word correctly. But in here, we do not have such a word. So this means that there was a mistake. And we need to say why. And we cannot just say that it is not a financial asset. We need to explain it. And this is where the definitions will come handy. So we will need to apply a definition of financial instrument. So we will need to say that, however, cryptocurrencies do not meet the definition of financial instrument because they are not contracts that give rise to financial asset of one party and financial liability or equity instrument of another party, because there is no entity that has to pay cash or has to share residual interest. So we're going to talk about the definition of financial instrument. And then we will have to apply a definition of the right standard. We do not need to talk about all of the standards. We do not need to explain why it is not IS2 inventory. In this case, we are going to apply the characteristics of IS38. We are going to say that, well, cryptocurrency is identifiable. It can be separated from other assets. It is non-monetary because there is no obligation to pay cash by any other party. And it has no physical substance. So it meets the definition of intangible asset. So that is how it is going to be recognized. Then we need to say how to recognize it. And by default, the recognition of intangible assets will be at cost. And it is important to say at cost, because if definition would say that the recognition is at fair value, then the situation could have been slightly different. In here, it will be at cost and it will be 100 million. Then we would need to talk about subsequent accounting. And it can be either cost model or revaluation model. However, for revaluation model to be applied, there should be an active market. As fair values are known, then probably active market exists, so revaluation model is the right model to choose, is the model that is going to give a more realistic picture, so it is going to be more relevant to the users. But either way, we need to charge amortization. So the company will need to see whether there is a finite useful life estimation. And if not, and in this scenario we do not have any, we are going to say that if there is no estimation, then there will be just revaluation and testing for impairment, and at each reporting date, the entity should assess whether the useful life is now finite, is now known. So what happens? So in previous year, the company revalued it at 105 million. So this means that there was some profit that was recorded. That is not right. It is supposed to be in OCI, and we have to state that this error should have been adjusted retrospectively. So this means that this 5 million will be recorded to OCI, and the profit recognized will have to be reversed. And that would be corrected retrospectively. Now, when we're talking about this year, we know that the value of cryptocurrency fell and they recognized loss. But hey, we also know that they started looking for a buyer. And if that happens, then this means that this non-current asset should be classified as assets held for sale. So we are going to apply IFRS 5 standard. And in order to do that, we will need to compare the carrying amount with the fair value less cost to sell. So fair value less cost to sell is going to be, we know that the fair value is 98. We know that cost to sell is 1% because that is the broker's fee. So this gives us 97.02 million. That is going to be the value at which cryptocurrency has to be stated on 30 November 2024. And amortization is going to stop, even if the company will know already the useful life, so will not be charged. And the difference that we are going to get is going to be recognized first in OCI. So OCI is going to get this revaluation, this impairment of 5, so up to the value that would be in the financial statements should previous upward revaluation never happen. And the rest would go to P&L. So that would be 2.98. Then we have this reporting period end. So we were told that there was loss. So we should say that it was wrong. So this loss has to be reversed. And instead, we are going to again compare the carrying amount with fair value less cost to sell. And fair value less cost to sell in this case is going to be 96.03. And this means that we have further impairment. So P&L will get impairment of, well, we had 97.02. And now we have 96.03. So we're going to have 0.99. And that is the impairment. And then we were told that because the buyer was sick with COVID, the sale happened later. We will need to see that this would not impact the designation if the sale is still probable. And then we were told that something happened after the year end. And if there is an elephant in the room, we should talk about it. So we should apply IAS 10. events after the reporting period. So we will need to say that this is a non-adjusting event, because the new fair value does not relate to the state of the cryptocurrency at the end of the year. Rather, it relates to the movement of the market. And that is how we apply our standards. So in here, we had IAS 38, we had IFRS 5, we had IAS 8, IAS 10, and also we had to apply IFRS 9, IAS 32 definition of financial instrument. And in here, we had cryptocurrencies, but the question was not really about cryptocurrency, not so much. And you need to work with your fear. You should not be afraid of the question just because it has a tricky word in it. You should know how to jungle the standards and how to apply the definitions and how to look for the answers in the scenario itself. And that is what I do. I hope that this was enjoyable for you. I hope that that was useful and educational. And I will see you next. Bye!